When you think about Warren Buffett, you think about this legendary, timeless investment philosophy. It's all about finding simple, durable businesses. But can a framework that old really make sense of a modern media giant like Disney? I mean, we're talking about a company juggling theme parks, blockbuster movies, and a super high-stakes streaming war. So that's what we're going to do, put Disney through a Buffett-style checkup and see what we find. So that's the big question, right? Could the Magic Kingdom actually pass the ultimate investor's test? We're about to put Disney through a disciplined, numbers-driven analysis to see if it really meets the high bar set by one of the world's greatest investors. All right, so to figure this out, we're not just going to guess. We've got a framework. We've boiled down this whole investment philosophy into a really simple three-pillar test that gets right to the heart of what makes a great long-term investment. Okay, so here's our game plan. It boils down to three simple questions. First, is Disney a fundamentally great business that's super profitable? Second, is it built on a rock-solid financial foundation? And third, the all-important question, can you buy it today at a sensible price? Let's dive into that first pillar. So what does Buffett even mean by a great business? It's all about having a durable competitive advantage. He calls it a moat that keeps competitors at bay and allows it to earn high returns on the money it plows back into the company. But how in the world do you measure something like that? Well, there's this fantastic metric called Return on Invested Capital, or ROIC for short. Basically, it tells us how good a company is at turning its money into more money. For every dollar Disney invests in a new theme park ride or a new series for Disney Plus, how much profit does it spit out? It's a key indicator of business quality. And Disney's current ROIC? It's sitting at 7.75%. Now, as a rule of thumb, anything over 7% is pretty good. It means the company is likely creating value. But, a single number is just a snapshot in time. What's way more important is the trend. Which way is this number headed? Okay, this is where it gets really interesting. Look at the direction this thing is going. Just a few years back, the 5-year average was a pretty sleepy 4%. Now it's nearly doubled to 7.75%. This is a huge deal. It shows a business that is becoming way more efficient and profitable. You're seeing the strength in the parks and the big push to make streaming profitable really pay off. That is a massive green flag for our first pillar. Okay, so check one, it looks like we've got a quality business that's seriously upping its game. But, even the most amazing castle can crumble if the foundation is weak. So for our second pillar, let's peek under the hood and check on Disney's financial health. First things first, let's talk debt. Disney's debt-to-equity ratio is 0.43. Now, in the investing world, anything under 1.0 is generally seen as pretty conservative. It means the company is using more of its own money than borrowed money to run the business. That's a very solid spot to be in, so we'll give that a big green check mark. But here's where we hit our first little yellow flag. It's the current ratio. This number tells us if the company has enough cash and other short-term assets to cover its bills for the next year. Disney's is 0.67. A number below 1 means it technically doesn't. Now, for a giant like Disney that generates cash constantly, this isn't a 5-alarm fire, but it's definitely something to be aware of. All right, let's recap. We've got a high-quality, improving business with a mostly solid balance sheet. That brings us to the final and maybe most crucial pillar, price. What is this business worth, and what is the market charging us for it today? This is where the rubber really meets the road. This table gives us a quick gut check. Just zero in on that price-to-earnings ratio. Right now, it's about 15. The average over the last 3 years? Over 34. It's trading for less than half its recent average. You see a similar story with the other metrics too. The quick takeaway here is that, compared to its own recent history, Disney stock looks pretty cheap. But, like the man himself always says, price is what you pay, value is what you get. Just because something looks cheap, that doesn't automatically make it a good value. We need to try and figure out what the business itself is actually worth. So how do we do that? Well, we use a tool called a discounted cash flow model. It sounds complicated, but all it really does is estimate what a company is worth today based on all the cash we expect it to generate in the future. And when we run the numbers for Disney, we get an estimated fair value of about $154 per share. That's our best guess at its true worth. So what's the market selling it for today? Well, as of the last close, the price was just over $102. Right away, you can see there's a pretty big gap between the price and our estimated value. Now, that gap, that is the holy grail for a value investor. It's called the margin of safety. And in this case, it's over 33%. Think about it like this. Our analysis suggests you can buy $1 of Disney's business for about 67 cents. That is exactly the kind of discount that gets value investors excited. All right, we've gone through our three-pillar test. We looked at the business, the finances, and the price. Let's put it all together on a final scorecard and see how Disney really stacks up. So, what's the verdict? On the plus side, we've got a business whose profitability is improving, and not just a little, but a lot. Debt is well under control, and based on our valuation, it seems to be trading at a significant discount. But on the flip side, we can't just ignore that low current ratio. And let's be real, investors who's held the stock for the last 5 years have not had a good time. The returns have been negative. So when you lay it all out, the data paints a pretty compelling picture, right? An improving quality company that seems to be on sale. But here's the thing about data. It's all about what's happened in the past. It's a look in the rearview mirror. The real billion-dollar question for any investor is, what about the future? What story is this data not telling us about the future of streaming, theme parks, and the enduring power of a good story?